Hey everyone, welcome back to Finbot Insights. Today we're diving into a topic that's crucial for traders chasing high returns: leveraged ETFs. Specifically, we'll unpack the ProShares Ultra S&P 500, ticker SSO. This fund promises double the daily returns of the S&P 500, but is it too good to be true? Let's break down the risks you need to know before hitting that buy button. First, the basics. The ProShares Ultra S&P 500 is a leveraged ETF designed to deliver 2 times the daily performance of the S&P 500 index. It uses derivatives like futures and swaps to amplify returns, and it's been around since June 2006. With over $2.3 billion in assets and an expense ratio of 0.9%, it's popular. But here's the catch. Leveraged ETFs like SSO are not set-and-forget investments. Let's talk about the biggest risk: daily rebalancing. SSO resets its leverage every single day to maintain that 2 times exposure. This creates a hidden problem called compounding risk. Imagine the S&P 500 swings up 10% one day, then drops 10% the next. The index itself ends down 1% overall. But SSO, it would surge 20% on day one, then plunge 20% on day two, leaving you with a 4% loss. Double the pain. Over time, this volatility erodes returns, even if the market goes sideways. Next up, volatility drag. Frequent market swings are kryptonite for leveraged ETFs. Let's say the S&P drops 50%. To recover, it needs a 100% gain. But SSO, with its 2 times leverage, that 50% drop becomes a 100% loss. Game over. Even in calm markets, fees like the 0.9% expense ratio and the costs of trading derivatives quietly eat into your returns. And here's the kicker: timing is everything. SSO is built for short-term trades, not long-term holds. If you misjudge the market's direction, even by a day, those losses compound fast. Imagine buying SSO before a week of choppy trading. You could end up with a portfolio that's bled dry by volatility, even if the S&P ends flat. Other risks? Let's bulletproof your knowledge. Liquidity risk. While SSO trades millions of shares daily, extreme volatility can widen bid-ask spreads, costing you more to exit. Counterparty risk. SSO relies on banks to honor its swaps. If one fails, ProShares uses collateral to mitigate this, but it's not foolproof. Tax headaches, frequent rebalancing means more short-term capital gains. Hello, higher tax bills. Psychology, leverage messes with your head. A 2% drop feels like 4%. Will you panic sell? Here's a real-world example. Suppose the S&P swings up 10%, then down 10% over 2 days. Your $100 in the S&P becomes $99, a 1% loss. But in SSO, $100 jumps to $120, then crashes to $96. That's a 4% loss. Double the damage. So, should you avoid SSO? Not necessarily, but use it wisely. Only experienced traders should play with this tool, and even then, keep positions small and timeframes short. Set strict stop losses, monitor daily, and never forget, leverage is a double-edged sword. If you learned something today, smash that like button, subscribe, and ring the bell for more deep dives. Let us know in the comments. Would you ever trade a leveraged ETF? Stay sharp, folks, and until next time, keep investing wisely.